Think your SCHD portfolio is safe? Think again. It might look like a solid choice for retirement, but there are risks hiding beneath the surface. Over 40% of SCHD's holdings are concentrated in just two sectors, energy and consumer staples, which means your portfolio could take a big hit if either of those sectors struggles. That's a level of concentration risk many investors don't realize they're taking on. But that's not the only problem. Relying only on dividend players like SCHD can mean missing out on major growth opportunities, and sticking to just one fund leaves you exposed to geographic blind spots. In this video, we'll show you how two ETFs, VXUS for global diversification and QQQM for tech-driven growth, can turn SCHD into a complete retirement blueprint. Let's break down why SCHD alone might not be as secure as it seems. SCHD stands out for its reliability, steady dividends, a roster of well-known U.S. companies, and a rock-bottom expense ratio of just 0.06%. It's no wonder so many investors see it as a cornerstone for retirement or income-focused portfolios. You get exposure to companies with strong dividend histories and names you probably recognize from daily life. On paper, it checks all the right boxes for safety and consistency. But there's a difference between a fund that feels safe and one that actually protects you from real-world risks. One of the biggest issues with SCHD is how much it leans on just two sectors, energy and consumer staples. As of early 2025, more than 40% of SCHD's holdings are concentrated in these areas, energy at 21.08% and consumer staples at 19.06%. That means nearly half of your money is tied to the fate of just two slices of the market. If either sector faces trouble, the impact on SCHD can be immediate and severe. For instance, when oil demand collapsed in 2020, energy stocks tumbled, exposing SCHD's weight in that sector without much cushion elsewhere. While consumer staples often feel like a safe bet, even they aren't immune to shifting economic conditions. A recession or sudden change in consumer preferences can hit these companies' profits and drag down SCHD's returns. This kind of concentration means you're not getting the broad diversification you might expect from an ETF with over 100 holdings. Instead, you're putting a lot of trust in a few sectors to carry your portfolio. Most investors don't realize that a single bad year for energy or consumer staples could set back years of steady dividend gains. It's a risk that hides in plain sight, especially for those who focus only on the number of stocks or the familiar brands inside the fund. Sector concentration isn't the only blind spot. Barron's notes dividend-focused funds often underperform broad indexes because they exclude the fastest-growing segments. By prioritizing companies with long dividend histories, SCHD naturally leaves out many high-growth names, especially those in technology and innovative industries. This means that while you're collecting regular payouts, you could be missing out on the kind of explosive growth that drives long-term wealth. Let's put this into perspective with a real example. Dave, a long-term investor, built his retirement strategy around dividend ETFs like SCHD. For years, he enjoyed the steady income and felt secure. But when he compared his results to friends who included growth-oriented funds, especially in tech, he realized his portfolio had barely kept pace. While Dave's dividend-focused strategy provided stability, it left him on the sidelines during some of the market's biggest rallies. That's the trade-off many investors don't see until years down the line: the comfort of steady dividends versus the missed opportunity for outsized gains. It's also important to note that SCHD's focus on established domestic companies means it can miss periods when smaller or more innovative sectors outperform. Markets move in cycles, and there are times when sticking strictly to dividend payers means you're not participating in the strongest parts of the market. Over time, these missed opportunities can add up, especially as technology and growth stocks continue to reshape the investment landscape. The key takeaway isn't that SCHD is a bad investment, it's that relying on it alone leaves you exposed to risks you might not have considered. Concentration in just two sectors, a bias toward large established companies, and the exclusion of high-growth industries all create gaps in your portfolio. You may think you're playing it safe, but the reality is you could be giving up significant gains and putting your future at risk if those favored sectors falter. So what's the real cost of focusing only on safety and dividends? The answer might surprise you. Missing out on growth is one of the biggest risks investors face when they rely only on dividend-focused funds like SCHD. While the steady income and stability are appealing, the real story is what you leave on the table by not including growth-oriented assets. Over time, this can make a huge difference in your long-term results. Opportunity cost is at the heart of this issue. When you put your money in SCHD, you're choosing reliable dividend payers over companies that prioritize innovation and expansion. SCHD's compound annual growth rate over the last decade was 10.56%, turning a $10,000 investment into about $27,300. Not bad, but compare that to the NASDAQ 100, which is packed with some of the most innovative tech companies. Over the same period, the NASDAQ 100 delivered a 17.71% annual return, more than doubling that $10,000 to over $51,000. That's a significant gap, and it shows just how much potential growth you might be missing by sticking with a dividend-only approach. Why does this gap exist? It comes down to the different ways companies use their profits. Unlike dividend stalwarts that funnel profits into payouts, growth firms reinvest heavily to expand. Think NVIDIA and Apple. These companies are constantly pushing boundaries, investing in new products, technologies, and markets. Their focus on reinvention and rapid growth means their stock prices often outpace those of more traditional, income-focused companies. While SCHD's holdings are built for stability, they rarely capture the explosive gains that come with breakthrough innovation. The tech sector, in particular, has driven much of the market's outperformance in the last decade. Companies like NVIDIA, Apple, and Tesla have not only changed the way we live and work, but they've also delivered some of the strongest returns for investors. Yet many of these names are missing or underrepresented in dividend-focused ETFs like SCHD. That's not a flaw in SCHD's design. It's simply a reflection of its strategy. But it does mean that if you're relying solely on SCHD, you're missing out on some of the market's most dynamic and fastest-growing businesses. This is where a fund like QQQM comes in. QQQM tracks the NASDAQ 100, which includes 100 of the largest and most innovative non-financial companies listed on the NASDAQ. With QQQM, you get direct exposure to tech leaders like Microsoft, Amazon, and Alphabet, as well as other growth powerhouses. And it does this at a cost that's easy on your wallet. QQQM charges just 0.15% annually versus QQQ's 0.20%, saving you money over decades. By adding QQQM to your portfolio, you're not giving up the steady income SCHD provides. Instead, you're adding a layer of growth potential that can help your investments keep pace with the market's best performers. QQQM doesn't replace SCHD's income. It supercharges your portfolio's growth potential alongside it. The combination allows you to benefit from both worlds, the stability and dividends of established companies and the upside that comes from innovative, fast-growing businesses. This balanced approach can help smooth out returns over time, reduce the risk of missing major market rallies, and position your portfolio for stronger, long-term results. But growth isn't the only blind spot to watch for. Even with both SCHD and QQQM, your investments are still focused entirely on U.S. companies. That means you're overlooking opportunities and risks in the rest of the world. Many investors don't realize how much of the global economy lies outside the United States, or how international markets can sometimes outperform the U.S. during certain periods. This lack of geographic diversification is another costly oversight that can leave your portfolio vulnerable to domestic downturns and limit your access to global growth. Understanding why this matters is the next step in building a truly resilient retirement plan. A portfolio built around SCHD might seem robust, but it leaves out a massive part of the global investment landscape. SCHD invests exclusively in U.S. companies, which means you're missing out on more than half the world's economic opportunities. This isn't just about skipping a few international stocks. It's about exposing your retirement savings to unnecessary geographic risk. When everything rides on the performance of one country, you're essentially betting your future on the U.S. economy alone. Geographic risk comes into play when your investments are concentrated in a single market. The U.S. has long stretches of strong performance, but no market leads forever. Political shifts, trade disputes, or a domestic recession can hit even the most stable-seeming portfolios hard. If you remember the 2000 to 2009 lost decade for U.S. stocks, you know how dangerous this can be. The S&P 500 delivered negative returns for a full 10 years, while diversified investors with international exposure actually saw gains. Relying only on the U.S. market means you're vulnerable to cycles that can drag down your portfolio for years at a time. That's where the Vanguard Total International Stock ETF, or VXUS, is designed to address this exact gap in emerging markets around the world. This isn't just about adding a few foreign names for the sake of variety. With VXUS, your investments reach into Europe, the Pacific region, and fast-growing emerging markets, each with its own economic drivers and cycles. VXUS's broad reach helps reduce the impact of any single country's downturn. For example, during the 2022 market downturn, VXUS experienced a maximum drawdown of negative 17.97%. While this was still a loss, it was less severe than the declines seen in concentrated, tech-heavy U.S. funds. This kind of diversification acts as a continents and industries. Another advantage of VXUS is access to companies and industries that simply don't exist in the U.S. market. Think about Taiwan Semiconductor Manufacturing, a global leader in chip production, or Nestle, which dominates the food and beverage industry worldwide. With VXUS, you're not just investing in different countries, you're gaining stakes in businesses that shape global commerce and can drive growth independently of the U.S. economy. This extra layer of diversification means your portfolio isn't tied to the fortunes of a single country or sector. The sheer scale of VXUS's diversification is also a major strength. As of April 2025, VXUS allocated 40.3% to Europe, 25.3% to Pacific regions like Japan and Australia, and 26.4% to emerging markets such as Brazil, India, and China. This wide coverage ensures that your investments aren't overly reliant on any one region and gives you a chance to benefit from growth in different parts of the world at different times. Markets move in cycles, and international exposure means you're positioned to capture gains wherever they arise. Cost is another factor that makes VXUS attractive. With an expense ratio of just 0.05%, you pay only $5 per year for every $10,000 invested. That low fee means more of your returns stay in your pocket, compounding over time and boosting your long-term results. For a fund that provides exposure to thousands of companies worldwide, that's an impressive level of efficiency. It's true that VXUS has historically grown a bit slower than the top-performing U.S. indexes like the S&P 500 or NASDAQ 100. But this slightly lower growth rate is exactly what makes VXUS valuable as a stabilizer. When combined with higher growth funds like QQQM or reliable dividend players like SCHD, VXUS helps balance your portfolio, providing downside protection without sacrificing the potential for long-term gains. Limiting yourself to U.S. companies creates unnecessary blind spots and leaves your retirement plan exposed to risks you might not see coming. By including VXUS, you reduce home country bias and open your portfolio to a much broader set of opportunities. It's a simple addition that can make your investments more resilient and better prepared for whatever the future holds. So the question becomes, how do you pull all these pieces together to build a retirement strategy that's built to last? When it comes to building a stronger retirement strategy, relying on just one ETF rarely covers all your needs. Instead, combining 3 ETFs, SCHD, QQQM, and VXUS, lays a foundation that balances stability, growth, and global diversification. Each fund brings something unique to the table. SCHD delivers steady dividend income from established U.S. companies. QQQM taps into the growth potential of innovative tech leaders, and VXUS ensures your portfolio isn't tied to the fate of the U.S. market alone. The challenge is figuring out how to blend these ETFs in a way that matches your stage of life and risk tolerance. To make this easier, let's look at 3 sample strategies, each tailored to a different kind of investor. Whether you're just starting out, juggling midlife responsibilities, or approaching retirement, there's a mix that can help you reach your goals. Consider young investor Alex, who's in their 20s or 30s and has decades to invest. Alex can afford to take on more risk because there's plenty of time to recover from market swings. For Alex, an allocation of 40% QQQM, 30% VXUS, and 30% SCHD captures the best of all worlds. QQQM's 40% weighting puts growth front and center by focusing on the NASDAQ 100's tech giants and innovators. VXUS at 30% brings in global diversification, allowing Alex to benefit from growth in Europe, Asia, and emerging markets. SCHD rounds out the portfolio with 30%, offering a stable stream of dividends and some protection during market downturns. This blend works because it maximizes long-term growth potential while still providing income and international exposure, key ingredients for building wealth early on. Next, take a look at Balanced Ben, who's in their 40s or 50s and balancing career, family, and mortgage payments. Ben needs a portfolio that grows but also offers some stability and income, especially as retirement draws closer. For Ben, a split of 40% SCHD, 30% QQQM, and 30% VXUS strikes the right balance. SCHD's 40% allocation anchors the portfolio with dependable dividends and exposure to established U.S. companies. QQQM at 30% keeps growth firmly in the mix, ensuring Ben doesn't miss out on market rallies, especially in tech. VXUS at 30% reduces geographic risk and provides access to opportunities outside the U.S. This combination helps Ben capture upside while smoothing out the ride, making it easier to stay invested through life's inevitable ups and downs. Finally, there's Cautious George, who is nearing retirement or already retired and wants to prioritize capital preservation and steady income. For George, a portfolio with 50% SCHD, 30% VXUS, and 20% QQQM is a smart choice. SCHD's 50% allocation delivers reliable dividend income and stability, which are crucial for covering living expenses in retirement. VXUS at 30% maintains global diversification, so George isn't overly exposed to any single market. QQQM at a moderate 20% keeps a foot in the door with growth, helping the portfolio keep up with inflation, but without introducing too much volatility. This mix increases stability by reducing the QQQM allocation, but it doesn't eliminate growth potential entirely. Each of these strategies uses the same 3 ETFs, but the proportions shift to reflect different priorities. Whether you're focused on growth, balance, or preservation, the right blend helps you avoid the pitfalls of relying on a single fund. It's not about chasing the perfect allocation, but about adjusting the mix as your life and risk tolerance evolve. And while these sample allocations offer a solid starting point, you should always consider your personal situation and adjust as needed. By combining SCHD, QQQM, and VXUS, you create a retirement portfolio that's more resilient, better diversified, and positioned to weather a range of market conditions. This approach doesn't just fill in the gaps left by a single ETF. It gives you more control over your financial future. If your goal is to build a retirement plan that stands up to uncertainty and adapts as your needs change, this 3 ETF strategy offers a practical and flexible solution. Now, with these 3 building blocks in place, it's worth stepping back to consider what relying on a single ETF really means for your retirement, and whether your current approach leaves you exposed to gaps you might not have noticed. A well-rounded retirement portfolio goes beyond just one fund. SCHD is excellent for dividend income and stability, but it can't cover every base. Adding QQQM lets you capture the growth of innovative companies, while VXUS brings in essential global diversification. Remember, SCHD for income, QQQM for growth, VXUS for global reach. Together, they'll fill each other's gaps. Take a moment to review your own portfolio. Are you truly diversified, or are there risks you haven't addressed yet? If you found this useful, like this video, subscribe for more retirement planning tips, and let me know in the comments which strategy you're considering.